who uses evaluations? Four main users that they've identified, especially in North America. Producers, so E&P companies, banks and financiers, pipeline companies, and governments. We're going to talk a little bit about what all of these users, why they use evaluations, and how they use evaluations. So producers are the heaviest users of evaluations. They have a lot of different purposes. They use it for year-end corporate reporting, as we've been talking about. Legal requirement for public oil and gas. That's SEC and that 5111. They know lots about that. Project economics. They use them to evaluate their own assets and decide and high-grade their capital allocations. Equipment infrastructure planning and sizing. So this is sizing the facilities. This is looking at if you're a large Montney producer, what do you have to build to be able to exploit and market your asset. They use them for internally for accounting. They use them for asset acquisitions and company mergers and acquisitions. So they use them to buy and sell oil properties and assets. And they use them as collateral for their banking needs. So one of the common uses inside production companies is to evaluate incremental economics on potential secondary and enhanced recovery projects. We'll walk through a quick example of a waterflood project and how they would look at incremental economics. They use subtraction to determine the incremental benefit of implementing something like a waterflood. A lot of numbers on here. What it's showing, they have a base case and a waterflood case. So the base case is going to be your primary production. You just continue to produce your wells on primary the way they're likely currently producing. You've got a production rate and a cash flow generated based on that base case. The waterflood case is a combination. It's the total case of the primary case plus the waterflood inflation. So the waterflood case is the total waterflood. It includes all the volumes you expect to get in implementing a waterflood. So you can see their production went from 3.2 million barrels to 5.1 million barrels, so they're getting a couple million barrels of increment out of their waterflood. So the incremental case, that's exactly what this is showing. The incremental case is simply the waterflood case minus the base case numbers. So this is just showing you the extra you're getting attributable to the waterflood. And then they discount the production, so they have the value, they have the revenue and the value every year, and they use different discount rates back to current day value in order to determine what the rate of return is on that investment. Here it's showing you what the cash flow looks like. So in the primary case, the initial cash flow, you can see there's no large upfront capital commitments. It's just continuing primary production. It chugs along and eventually it ramps up a little bit, and then it eventually goes into a decline phase. This ramp up probably has to do with pricing. You can see there's a large initial investment. There's a large capital cost to implementing a waterflood, so you take a big hit in the first year. So it looks like they're looking at investing roughly $3 million to implement the waterflood. But then you start to see incremental volumes in response from the waterflood, so you start to see a higher cash flow in future years. So this is the increment. So this chart is if we take the initial cash flow, if we take the waterflood cash flow and we subtract the initial cash flow. So this is just showing you the incremental cash flow. And taking a step back, cash flow is your total revenue minus your expenses. So then again, they go back and they discount it, and they show this is basically giving you an idea of rate of return on the waterflood. You can see that this is a very profitable waterflood. It's showing roughly a 40% discount rate. So that's one example of showing you how a company internally will evaluate a potential project, and then they will compare it to the current case or what their current project is, and decide whether it's worth the capital investment, whether the capital investment meets their required hurdles for a rate of return or return on investment. So that's one example of showing you how a company internally will evaluate a potential project, and then they will compare it to the current case or what their current project is, and decide whether it's worth the capital investment, whether the capital investment meets their required hurdles for a rate of return or return on investment. Another very common case is acceleration economics, so this is drilling infill wells. We did talk a little bit about a couple of these examples. Could also be compression. We talked about adding compression to gas gathering and how that can give you an increased rate in the short term, even though it doesn't necessarily impact your long-term reserves. This is getting more production out of the ground quicker, but not necessarily more production, more ultimate recovery in the end. So they did the exact same thing. You've got a base case, you've got a case where you have a whole bunch of infill wells, and then you've got an incremental case, which is the additional well case minus the base case. You can see by acceleration, they've shortened the timeline for total recovery. So here they're getting the exact same total production, roughly 2.5 million barrels in both cases. The only difference between the two cases is that when they infill drill, they recover that 2.5 million barrels in about 12 years rather than about 18 years. Again, looking at discount rates and rate of returns, base case versus the additional well case, and the incremental net present value. Same flow we saw before. We got our base case cash flow in blue. We've got the accelerated cash flow in red. So that you can see a little bit of capital investment up front to drill the infill wells. Then you start to accelerate your production. And at some point, you recover your production more quickly. So your production ends earlier. And so you get less cash flow in the long term, but more cash flow up front. And because of the time value of money, this is a net benefit from a value perspective. Kind of a funny looking plot, but that's just showing the subtraction. So again, that's the red curve minus the blue curve from this plot. It's showing you that you have incremental cash flow in the first 6 or 7 years, and then you have less cash flow in the later years. Your discount rate, you can see it's very attractive. It doesn't require a lot of upfront capital, and it gets you a lot of additional revenue in early years, so it has a very high rate of return. Companies can either choose to evaluate properties on a standalone basis where they assume that corporate tax benefits don't apply to the property, or they can do what's called a flow-through analysis where they incorporate all of the corporate incentives that we have in North America. Governments allow companies to recover a lot of their costs through corporate tax incentives. Again, they do the same sort of thing where they just analyze both cases. And you can see there's a different indicators at the bottom. You've got an NPV 10 and you've got your internal rate of return. And you can see on the standalone project economics, your internal rate of return is about 11%. And on flow through, it's about 12%. So the tax incentives that you have as a corporation do help your return on investment as a company. This is saying that when we're doing evaluations, we don't incorporate any effects of how the company raises capital. So if the company has to raise capital through debt equity, or they have to issue debt, they have to pay a rate of return for that debt. So there's a cost to raising the capital. When we're doing oil and gas evaluations, we don't incorporate the cost. That gets incorporated on the accounting side. So in our revenues and cash flows projections, we don't incorporate any interest costs for raising capital. This is just talking about loans, principals, the interest they have to pay for those loans. For oil and gas evaluations, we don't look at that. But what this is saying is internally companies can, and they can evaluate the rate of return of the project, incorporating the cost of that debt. And you can see this one makes a much bigger difference. So your internal rate of return, 20%, 14%, versus 32% and 24%. So that's showing you that if you leverage debt, you can actually significantly improve your rate of return if you do it properly. Accounting, property, plant, equipment. So PP&E, you'll see a lot in AIFs and company disclosures. Again, I'm not going to spend much time on this. It's not really relevant to you. There's two different types of accounting, successful efforts and full cost. They're both referenced in SEC. I believe in Canada, we only use full cost. This is looking at a balance sheet and just showing you where PP&E shows up on a balance sheet. Securities reporting, so we've talked a lot about this. This is the whole point of NI 51-101 and SEC, Goodwill S-K and S-X. Public disclosure, in Canada it's regulated by the Alberta Securities Commission and the Canadian Standards Administrators, and in the U.S. it's the Securities Exchange Commission. They require an annual disclosure for publicly traded companies, and you'll see that annual disclosure in all of their AIFs and usually their prospectuses, which are just public disclosure documents. This is just showing you a table. If you're interested, I can actually pull up a real AIF this is just one small component of the disclosure. But this is showing you the standard format that you'll see in a lot of reserves reports, where it breaks down reserves by proved, probable, proved plus probable. You have your volumes up top, and you have your this is both NPVs, I guess. This is just summary of net present values. Oh, it's before and after income tax, that's what it's showing. So in addition to NPVs, you're going to have volumes, you're going to have descriptions of your properties. Form F1 in Canada, that basically tells you everything you have to disclose is quite in detail. There's a lot of data you have to disclose, so there's usually going to be 15 or 20 pages in an AIF of just reserves data. This is an accounting issue. They do use reserves in calculating annual depreciation numbers for accounting processing. They also use it for ceiling testing, which is basically a measure of a company's ability to service their financial obligations. Here it's saying it's to ensure that property, plant, and equipment does not exceed the value of the assets. Unique to the resource industry, the test is different in Canada and the US, and the test is different for the two different types of accounting. So ceiling tests are run by accountants, they're not done by evaluators, they're not done by engineers, and they're really assessing the ability of a company to continue to operate on an annual basis. Another very common use, buying oil and gas reserves. So buying properties, buying companies. They'll either buy a whole corporation, which we were talking a little bit about Petronas earlier, that's what they did with Progress, or they might buy individual property from a corporation. They do that to increase their land base, to secure oil and gas reserves. Every company has a different take on oil and gas properties. There's a lot of subjectivity in the oil and gas industry. So while one company may not have a high priority on a certain type of asset, and so it makes a lot more sense for another company who's focused on that type of asset to purchase it. So that's why we constantly have transactions going on in the oil and gas industry. So why do they do it? To increase their reserves, production, and cash flow, geographical synergy. So you'll see some companies. Recently, there's been a few of the super majors that have started to divest their Canadian assets, trying to focus on other areas of the world. So companies are constantly evaluating their oil and gas portfolios, and they're often buying and selling oil and gas assets to facilitate that. Like I was talking about, they may see overlooked potential. So if one company doesn't prioritize a property or asset, and another company sees potential to implement a capital program or increase the reserve somehow, that's how a lot of transactions come to be. And it may be cheaper to buy than to explore. So exploration can be a very expensive, high-risk endeavor. So a lot of companies find safety in purchasing assets that have already been delineated or explored. Why do they sell reserves? Dispose of minor interests. So these are non-focus areas or non-key areas for companies or corporations. They're better off divesting them if they don't have the resources to develop them. They can monetize developed properties for exploration funds, so they can go the opposite direction. Sometimes companies will buy up an area that's unproven, they will prove it up, divest it, and then they will take those funds to apply to the next exploration target. And sometimes when companies are in distress, they're running into cash flow issues, they're running into debt problems, they will sell properties to service their debt. Buying a company, generally the purchaser buys the shares of the other company, they acquire the existing tax pools, and they generally value it based on future cash flows. So again, this isn't super relevant to you, but this is just how oil and gas transactions occur in public companies. Generally, they're essentially, when they're acquiring a company, they're essentially buying the reserves of that company. That's really what they're getting. It's all based on the cash flow method, which is the evaluation method that we use for all of our oil and gas assets that we talked about yesterday. And again, taxes can have a major impact purchase price, NPV, and the value of the company. So tax pools can have a material impact on rate of return. Profitability measures that companies use when they're analyzing purchases, net present value, so we talked a lot about that. PI ratios, payback, multiple year first cash flow, dollar per barrel of reserves, dollar per barrel of oil per day of production. So all these metrics, we have companies specifically in Canada and the US that track a lot of these metrics for every transaction that occurs between oil and gas companies. And they put out reports where these numbers go into the public domain, and we'll see a couple of plots of some of these metrics over the years. So companies have a lot of different ways of valuing assets. They won't just take a look at the reserve report and see what the NPV 10 is and say that's the number. Different oil and gas assets have very different value propositions. So there's a lot of different metrics that companies look at when they're analyzing a purchase or a sale. So here's one of those plots I was talking about. This is by a company called Sayer Energy Advisors. They track oil and gas transactions in North America mostly. And so what this is showing you is for oil properties in blue and gas properties in red, or gas oil reserves and gas reserves, the dollars Canadian per barrel of oil equivalent that was paid for those assets. So you can see a stepwise change as we moved into the 2000s and we hit the high pricing scenario, and then you see some hits in the late 2000s, but we've generally been in up until very recently, up until 2013, 2014. We were in a relatively high pricing scenario. So people were paying a lot of money for oil and gas assets in the mid to late 2000s and early 2010s. Median price for production, dollars Canadian per BOE, just another metric, again, just showing you that the way that oil and gas assets are valued and purchased is tracked in a lot of detail in North America. Corporate versus property transactions, so this is saying in blue you have purchases of entire companies, and in red you have purchases of individual oil and gas assets and how they stack up. You can see they're pretty close. The reason that corporate assets usually have a higher transaction rate is based on some of those tax implications we were talking about before. When you purchase a property, you're also purchasing a bunch of tax pools and incentives that help you achieve better after-tax returns. Banks. So now we're moving away. We looked at everything that producers generally use evaluations for, as banks, lenders. Banks will generally focus on very conservative estimates of oil and gas because there's so much uncertainty in our industry, and the banks like to be very certain with where they lend and put their money, invest their money. They'll generally focus on PDP, and they'll generally apply a fraction of the PDP value to what they think is very certain. So this is just talking about a couple of metrics that banks use when they're taking a reserves report and evaluating how comfortable they are loaning money or financing oil and gas operations. The most important point is they generally focus on proved, and they almost never look at 2P. It's interesting because they never look at the best estimate, they look at the conservative estimate. Finally, governments. Governments like yourselves require information on reserves and production. They use the information to implement and modify legislation and policy. And it's key to the security of national energy supply for a lot of countries. So the government needs to have a handle on their oil and gas assets, which is why they require evaluations. So you can see between the 3 or 4 different types of users, between producers, between banks, between governments, they have very different intentions, which is the challenge of using something like a NI 54-101 or an SEC, a public disclosure document for government purposes, because your ultimate intent as a government is quite different from what bankers and investors are trying to understand about the oil and gas industry.